Hi, and welcome to That's What You Think. This is a podcast where I'll welcome guests who are heavily opinionated, like guest number one here, to offer opinions chiefly in the technology, financial services, and sustainability space. My first guest is called a few different things. Firstly, he's called Ben Ford, sometimes Mr. FinTech, sometimes known as the fittest dad in Sydney, while his shirt's off, but his shirt's on today. So big warm welcome to Ben Ford. Thanks very much for joining me.
Scott, it's a pleasure. Thanks for having me. Some of those names are accurate. A couple of them aren't, but we'll save that for later. And you get me in a shirt today. So
we'll see how long that lasts. Yeah. Good man. Listen, Ben, whether it's fintech events in Sydney, like the Finnies last night, Bangkok, Amsterdam, China, you're kind of there, from my perspective, and we're going to talk about open banking today chiefly, more broadly, you are somebody who has a lot of touch points within the fintech industry in Australia and globally. You can give us judgments about where we're at here versus other regions. But give me a sense of how your career evolved into what it is today and exactly what it encompasses today.
Okay, I'm just wondering how we begin this story, Scott. But thanks for the introduction. I guess I'd sort of describe myself probably harshly as a bit of a fintech dilettante. And basically, I've been around for such a long time now that sort of I've got to know, like a cockroach, I'm sort of unkillable in the fintech ecosystem. So I've been around a long time. I've seen a lot of sort of changes, a lot of companies come and go, been able to work with them and as a vendor sell into a huge number of them, probably close to 150 now, I'd say. And that's given me, I guess, a good view and a good lens on the overall industry. And then with various jobs I've had along the way, it's sort of afforded me some good opportunities to travel. And then lately, I've been able to sort of parlay that or merge my other passion, which you mentioned, which is fitness and fintech together, which sort of seems like quite a fun, frivolous thing, but actually is increasingly, I'm seeing, particularly amongst sort of startup founders and fintech founders wanting to do right by their team and provide opportunities for the team to stay fit and healthy. And also, I guess, the sort of link between mental health and physical fitness and how that can sort of keep founders going, because it's a pretty tough job founding a fintech company or any startup. And if you don't look after yourself or that side of things, there can be some pretty bad knock-on effects.
Yeah, and I definitely like to get to that part on managing work-life balances and things. Now, talking about your career, I met you, I think 8 years ago now.
Yes.
A different life. I was running a financial services firm.
I remember.
And you were working for a company, Yodlee, a big sort of US tech play. At the time, we were doing some personal financial management stuff, looking at how to scrape sort of data for customers and aggregate that into some API things that we were building. And I guess at the time, the only real tools we had to aggregate that data seemed to be scraping data from third-party sites, which involves handing over credentials, usernames, passwords, to just about as sensitive as it gets, big banks, I guess. At the time, it seemed fairly reasonable because I don't think there was too much around in place of that in Australia that was operational. Looking back, it seems kind of a bit bizarre, but I'd love you to give me a sense of where we've come from that time and how the open banking landscape in Australia has evolved.
Okay. I think probably it's worth even going a step further back from that to get to the point where why would anyone be doing that? Why would anyone be sharing their financial information and what benefits could it bring? So because like you say, it seems the idea that you would sort of pony up your online banking credentials or your financial details to a third party to enable some kind of data sharing just all seems very, very, very murky. But how I sort of chanced upon this, and this was before my time at Yodlee, was working for Dun & Bradstreet, the credit bureau, and we'd have clients who were lending, and they were probably lending companies like sort of cash converters, you might call them payday lenders, or sort of lending to a certain category of customer that perhaps couldn't get funding from the banks. And it sort of came up in conversation when we were sort of selling credit checks. Is they were saying we're getting our bank statements or we're getting bank information from them using this method, and we sort of said, well, who in their right mind would actually do that? And the answer was, well, it's people who really need the money, and they really need the money quite quickly as well, and they're prepared to share that information because it's kind of a trade-off. I need the loan for whatever short-term means today or tomorrow. The way to do that is to provide my credentials so I can get a quick and easy lending decision. So that's kind of the backdrop for that. And then the penny dropped. And then, we had companies come along like Afterpay. We had companies like Zip that have been absolute success stories at various points, mostly success stories. And it just became sort of quite pervasive. These are kind of the early fintech companies in Australia, probably sort of round one or the first wave of fintech type companies using this methodology. And then there were organizations like yourselves and other companies like Frollo where I've worked, where the idea would be that by sharing your online credentials or linking your bank account, you can see all of your financial information on a single app or a single dashboard or a single website or something like that. And that was essentially what sort of attracted me to the role at Yodlee, because it was, what a great idea. Instead of having to go into my superannuation website and the account there to see my balance there, instead of having to go to my bank to see my savings, instead of have to go somewhere else to see whatever else my investments are, I can see it all on a single dashboard. And it's sort of quite a powerful concept for people, I think. And this concept of a super app, and then businesses like Revolut sort of internationally sort of spawned, and we've had real success stories with companies like Pocketbook here in Australia. They were kind of the first sort of smash hit PFM, personal financial management tool. They sort of got to 400,000 customers or users, which for an app, for a consumer app in Australia, I generally say anything over 100,000 is kind of very good going. If you get to sort of plus 250,000, you're doing really, really well, and you've potentially got a pretty good business there. So Pocketbook sort of laid that foundation, and then people like Frollo followed on that. So I spent some time working at Frollo, and these are all about these are apps that are promoting financial literacy, financial wellness, financial inclusion, helping people get a better handle on their finances, get themselves out of debt. There's a great company called WeMoney doing exactly that at the moment, and they've sort of taken the mantle, and they're probably the last sort of, the last remaining true personal financial management tool. There's still new ones coming to market, but they've kind of nailed the brief, I think, to a certain degree. They've probably had 1 million app downloads, probably 1.5 million. Actually, I'm doing them a bit of a disservice there. So, long way of saying the sharing of your data, however you do it, can provide real benefits to a consumer, whether it's getting funds that you need immediately, or whether it's being able to manage your finances better and create more wealth for your family as you're sort of going through life or whatever. So that's why screen scraping that we talked about, the idea of sharing your online credentials with a third party took off. And then I guess part of a sort of, and we'll get into sort of how the open banking globally and how it all came about, but there's been this sort of theme or thematic or trend across a number of different countries over the last 7 or 8 years. And the idea has been to make it easier for consumers to, I guess, more legitimately port that data over or share their data with whoever they want so they can get better financial products, and not let the big banks here, particularly here in Australia, sort of have this sort of lock and key hold over your finances. And if you want to go to a smaller, more agile, cool provider that's got some really cool disruptive products, don't let the bank say, no, we're not going to share the information with that other party because they don't want to, they view it as a competitive threat. And that's led to this open banking, global open banking sort of theme and trend. In some countries, it's been brought about by legislation. So in Australia, we have something called the Consumer Data Right. Probably we'll try and avoid going into legislative terms and things like that because it gets a bit nerdy and a bit boring. But suffice to say, or we'll sort of describe it, that it's been very prescriptive in Europe, been very prescriptive here in Australia. In other jurisdictions, it's been less prescriptive, and actually industries have sort of come together and done it for the greater good. And that's sort of, that's this open banking ability to more legitimately than screen scraping and easily and securely share your data with whoever you want to enable you to get better financial products and better financial outcomes.
And are we on the right track? Because, we talk about this evolution, and we talk about Australia's taken a particular approach in trying to operationalize this and legislate it. but I still don't see it. I loved Pocketbook. I thought it was great. I don't think they were able to sort of monetize it sufficiently. I think it got bought by Zip,
Correct.
and then disbanded, unfortunately. And I know there's a couple of startups at the moment doing PFM apps, which is great. But still, in 2025, I don't have an app on my phone that aggregates all my stuff and tells me everything. And I still feel as though the big bank accounts that I've got aren't doing anything to welcome any other open banking data to come into their platforms. So I don't see any of my Westpac, Commonwealth Bank, HSBC commingled. It's all just separate apps still in 2025. Have we done something wrong? Have we adopted the wrong model? What's happened?
We're probably living in the wrong country, Scott, if I'm honest. I heard an interesting stat the other day that I think 10 million consumers in the UK have engaged with open banking in some capacity. And so I know the UK's got a 65 million people population, maybe 40 million of those people, maybe a bit more, are credit active.
Yeah.
So 1 in 4, so 25% of the population who could interact with open banking in some capacity have done so. Okay. In Australia, I reckon we're probably at maybe 5%, if that, to your point. And I think we've got a fundamental problem in Australia in that the big four banks and other banks have a lot of power. They've sort of been dragging their heels on open banking. What's pretty interesting is they detested screen scraping when it was around, because it did involve, I think there was some concerns it invalidated the e-payments code. It was dangerous to share your credentials. Security breaches were a risk and all that. There's never been a screen scraping data breach, first and foremost. So that's sort of something there.
Not one.
Not to my knowledge.
Okay.
No. So, and definitely not here in Australia. I might fall on my sword there, but happy to be proven wrong. But the big banks, or a big bank, once put the kibosh on screen scraping. They didn't like it. Sort of, viewed it as a very sort of nefarious way of people getting hold of data for whatever reason. Obviously, viewed it as an existential threat to possibly to them. So they blocked screen scraping from one of the biggest apps in Australia. That was Raise, formerly Acorns, which is a roundup app. Again, you go back to sort of the genesis or why fintech is so cool. When Raise came out in 2016, or Acorns as it was known at the time, you could link your bank account or link your bank card to the app, and every time you tap that card to buy a coffee, it would round it up to the nearest dollar, put 50 cents in an investment fund. Now at the time, so that was great. Millennials had no way of starting to get on the investing bandwagon, start to build a portfolio of managed funds, ETFs, low-cost funds and things like that. So suddenly you've sort of democratized wealth management and investing, so people can get in and learn about it when they're 18, 19, 20, and start to make savings. So that's a great app. Yeah, still exists today. Great business, a real sort of fintech success story, and something that's sort of really positive societally, I believe. A bank blocked screen scraping. So the users of, and there was a bit of an outcry, but not really much could be done because the bank was one of the big four. The users of that app, because there were probably about 300,000 in number back then, maybe 250,000, they were told to complain to CBA, which they did in their droves, because suddenly they were no longer able to do their roundup transactions and no longer able to passively invest and build up a little sort of small nest egg that could grow into something else. They did so in such numbers that CBA instantly put the screen scraping back on. Yeah, but I've named names there. I shouldn't have done that. But I'm fine with that. So the point of that, I guess, is at the time screen scraping was the enemy. It now feels like the banks hated screen scraping, wanted to block it. Then something else came along, which they actually viewed as potentially an even bigger threat, and that's open banking, because now it's porting data and making data freely available for people to share, but it's legitimized. So that's an even bigger threat potentially, is kind of my take on the situation, or my take on how they perceived it. So they actually dislike open banking more than they disliked screen scraping before, which is kind of a weird sort of reverse, if you like. But certainly I don't think the banking sector in Australia, I think they're missing a trick, because actually open banking is a massive opportunity for them to win market share from their competitors, but actually they view it as a chance for them to lose market share to other fintechs, I believe.
Yeah, a bit of an own goal, I guess. Careful what you wish for. Now the technology's come along that says, and presumably there are, there's a mandatory requirements for the big banks to play ball. I believe there's been some fines handed out for dragging of heels, etc. But let me play devil's advocate. I'm a big bank. I've built my business. I get bashed over the head by APRA from time to time. Go through royal commissions. I've got this customer base, and you talk about it being an opportunity, but I wonder if I'm, let's say, a market leader or part of the big four. I've got very sticky relationships with my customers. They have savings accounts, term deposits, home loans, perhaps broking accounts with me. Perhaps everything feels like a threat when you're in that position. What are there opportunities for them to, why would they do it? What's the reason for them to do it? Can they monetize it? Can they set up tollways and charge for this data, or can they not? Do they have to open it up and give it away? Because obviously, whatever the incentive is, it's not working because, like I say, as a consumer, I just don't see it. It's not developing.
It's probably still early in the piece. It's probably a 10-year project. So the legislation came in 2018, I forget when it sort of exactly was released. So we're probably still a few years away from some kind of maturity. You mentioned the stickiness of the customers to the banks. I guess the question is, are they sticky because they're sticky in a good way because they're loyal and they're getting deriving loads of benefit from being a customer of yours, or are they sticky because they can't go anywhere else?
Yeah.
And I think that's probably the sort of key differentiator there.
Couldn't be bothered to go anywhere else, or can't go anywhere
Well, then
else?
we're going to start talking about the lazy tax.
Yeah.
So, the argument is I think there was a study done by Queensland University of Technology and someone else. It was a few years ago, but it found that Australians as a population are missing out on about 12 billion, or leaving $12 billion on the table annually in terms of not shopping around for better interest rates, being overcharged for products that they can't get out of, and all that kind of thing. So if people did have the freedoms to do that, now you could argue that it's inertia. To your point, people can't be bothered to do stuff and just happy to sit on a mediocre product, and that's probably true to some degree. But if it's so hard to actually switch to a different product or a different provider, then that's not really operating for the good of society. So I guess it depends. And a bank might say, well, we're here to make profit for our shareholders and our stakeholders, and that's completely fine.
Yeah.
But don't then also pretend to be looking out for your customers if you're not necessarily doing that. And I guess to that point, I would say I've had a go at this myself. So I changed my super fund recently, or probably a couple of years ago, and I'm sort of reasonably, I'd like to think, financially savvy. Finding out the fees that my new super fund, which is a very low cost fund, was going to charge me, I had to go through a 30-page PDF product disclosure statement and document, and the combined fees were across 3 different pages. One was on page 8, one was on page 16, and the other one was on page 21. So I had to fossick around like Hercule Poirot to try and find out what the total fees of my super fund were, to make a comparison to decide whether it was worth moving to it from where I was at the moment. Now, to your point, the average punter is not going to have the knowledge to do that. They're not going to have the inclination. They probably will give up. And that's just, I know it's a bit of an extreme example, but it's kind of emblematic of the problem. So if it is made easy, and I think the open banking sell should not be open banking is good because you can do this. It should be more open banking could save your household a collective $10,000 a year. Would you do it? Would you do it? Would you do it? Everyone would do it, I think. Yeah. It requires a bit of work, but it's pretty easy because the plumbing and the infrastructure is there, and your providers are going to make it super simple to understand what you're doing and how to execute on that. And I think that is probably where we want some of these apps and some of these agentic AI sort of elements behind them. We're probably wanting to get to that stage, and that becomes a much more compelling proposition than open banking can help you switch a bank account, because that's not particularly sexy.
Yeah. All right. We'll talk about some of those accelerators in a second, because I think they're important. Obviously things aren't moving quickly enough. What is it that's going to come along and move it along a little more quickly than it is at the moment? But you mentioned the lazy tax. So from my layman perspective, the lazy tax is a tax on the consumer for not chasing returns as proactively as they might. We know we've all been guilty of having a zero interest savings account sitting there with a couple of $1,000s in it, not really thinking about it too much. But of course, for every dollar that earns nothing in my bank account for me, there's interest earned by the bank. So the direct correlation between the banking earnings, the customer earnings, and maybe social license on top of that to say, hey, I'm going to do the right thing by you. You reward me with loyalty and don't switch. Describe to me in your words the lazy tax, and perhaps who's at fault for this advent of a lazy tax?
Well, I think it did a pretty good job. I mean, essentially, it is that inertia. It's the admin hurdle of doing all the things that you described and I described previously. So I think, as I say, my own personal experience with that superannuation example was I personally don't think that's the consumer should necessarily have to have that level of expertise or that level of doggedness to hunt down the fees so they can make a comparison. And don't forget, we're talking potentially over the 20 or 30 year period, we're talking hundreds of thousands of dollars in fees, and the manifest difference that would make to the pot that you end up with. We're talking $1 million goes to $1.5 million.
Yeah, for a single account we're talking about.
Absolutely. So these are not sort of small amounts. And to your point, someone sort of sitting there because 0.25% on the fees or 1% differential on the fees. I've got a bit of a problem with that because I think that is not necessarily. I think calling it the lazy tax is probably a bit of a misnomer, and it's sort of the difficulty or the troublesomeness tax of shifting or switching accounts.
So to combat this, we want not just technology and regulation and rails, because they all seem to be there now, but we need some sort of accelerant to mobilize this money. And I would like to think at some point, when I open my iPhone, something might say to me, hey, do you know you could save 10 basis points on your home loan by switching to this?
Brilliant.
What are the sorts of things that will come along? Who are the challengers who can bring this? Because, are they other banks because they need to be able to monetize the business to survive and thrive and take some sort of clip or fee on the way through, I'm sure? Is it the disruptive fintech companies that have an alternate model to monetize a service like this? Is it fee for service on a monthly basis? What is it? What's the business model that comes along and says, okay, I'm an innovator, I'm an entrepreneur, I've found a way that I can get scale and profitability by helping port money from one bank account to another using these rails that have been developed?
Yep. I guess the case study there, or the I guess jewel in the crown in the Australian fintech ecosystem at the moment is a company called WeMoney, which is a money management app. You link all of your accounts using open banking. So again, you've got the safety, you've got the guardrails of a regulated way of getting the data in. They effectively scrutinize your accounts and see if they can serve you with better offers elsewhere. Now, what they did differently to, say, a Pocketbook and some of the other personal financial management apps, they monetized it from the get-go. So I don't know if it's still the case, but at the time you have to go through a full ID verification check and a credit check when you downloaded the app, which is quite a friction-full experience when you're signing up to a new app. So a little bit more pain there on the way in, but then all of a sudden I got a notification from them within the app saying, you could get a better interest rate on your mortgage. You could see that you're with HSBC, you're paying 0.5% or 0.25% more than you could get elsewhere. Do you want to make the change? And at the time, I hadn't linked my HSBC account because you can't really link HSBC accounts. But that's a different story using screen scraper. You can now with open banking, of course. But I thought it was quite intrusive. But then I thought about it. I was like, well, I ended up going back to HSBC and getting the 0.25% or 0.25 taken off my own mortgage. So I was able to save them, didn't need to shift. But it saved me a significant amount of money over the course of 12 months, just by them sort of running rule over one of the accounts that I hadn't even linked. They'd seen it on my credit file. So, and they would then get a clip or get a kickback from the loan provider that if you do end up switching, you end up switching to. So that's their monetization model. If your offer is compelling enough, I don't really think it matters what the business model is, Scott, to be quite honest with you. But you've got to be able to clearly articulate what savings you're going to deliver. And then would people pay a subscription for a premium type solution? Probably.
Yeah.
If it was good enough. Revolut has that.
Yeah.
They've got, I don't know how many millions of customers globally, but they're worth $50 billion or more.
Yeah, this is true. And I guess in a world where more physical banks are closing, nobody expects good client service from a big bank anymore, frankly. Like, I know a lot of people who welcome the advent of AI chatbots being able to respond to them more quickly than wait in queues, because we're all a little fed up. So maybe there is a banking services are a little more commodified than they used to be. People are becoming more willing to put more material amounts in, let's say, a Revolut or a Wise or an Upbank. Well, Upbank's a different story; it's backed. But the landscape is changing. I wonder, however, you mentioned something which was really interesting, which was that you started exploring opportunities to save some money from HSBC. You came back and renegotiated something with them. I remember, after rates got heavily cut after the GFC, there was all this sort of swapping between banks and chasing better interest rates. And particularly when people came off fixed rates after rates bottomed out, when rates started to climb, some people had been fortuitous enough to lock in 2% home loans for a couple of years. They were expiring and everybody else was chasing deals. And the banks suddenly became a little more competitive and a little more one-to-one with their customers. So rather than just advertising their standard variables and possibly giving, some bespoke marketing-led discounts, everybody was haggling on a phone call with an employee from a bank about shaving, 10, 20, 30 basis points off a home loan. So open banking comes along, the government does its job, makes it mandatory for the big banks to open up their data, does the job on CDR to make sure consumers are protected and your privacy is protected and you have control over your data. Then a challenger comes along and says, hey, I can start facilitating this stuff and finding you better home loans. I wonder if we'll go full circle and those banks will say, right, I've had a request from a third party to offer your data. Someone gets on the phone, Ben Ford, I can cut your rate by 15 basis points if you'll stay. I wonder if we'll see that.
Absolutely.
Yeah.
Absolutely. Yeah.
So irrespective of what happens, it's going to be better for the consumer.
Should do.
We just need these accelerators to come along and kick it into gear.
Yep.
You talked about the UK model. 1 in 4 of their active sort of population with regard to credit products having touched open banking at some point. Where does Australia rank and how does it compare? And I understand the US is a very different story altogether.
Yep.
But what are the kinds of things that are happening overseas that we could be doing a better job of to sort of activate these processes and get them going?
Well, I mean, there's a very easy answer there, and that fundamental difference between the UK. There's two main differences between open banking in the UK and open banking in Australia. First is that payments, or the movement of money, action initiation, as they call it, but we'll just call it open banking payments for the sake of simplicity, has been part of the regime there since the get-go. It's not included here at the moment. So what you're sort of talking about there is it's all very well to be able to use open banking and use the open banking rails or plumbing or pipes to share data. But what if you can but what if you can then cause it to move money on your behalf as well? So sort of seeing the data is one thing. You can sort of show someone some data or what have you, but you can't necessarily move funds at that point, which is kind of in a very simple level what's happening in the UK. So that's 50% of the open banking transactions in the UK from memory are now payment related. Okay, so that's a big difference. Okay, the second one is that screen scraping was kind of phased out or banned or
kind of. I got hit up by HSBC for a credit card application that asked me to put in my Westpac details of where my salary was paid.
Really?
Yes.
Interesting.
A couple of weeks ago.
Okay. But in the UK, it was banned, screen scraping.
Right.
So what that meant was once the banks were operating under they call it, I think it's they have the big 9 or the 9 largest banks in the UK. Once they were up and running with functioning and solidly performing open banking data, screen scraping was then phased out. I don't know exactly how it was sort of staggered and timed or whatever, but so you didn't have two essentially competing ways of sharing data, one of which is screen scraping, which is suboptimal, but an okay way of doing it. The other one is open banking, which is the optimal way of doing it, regulated, government mandated, secure, reliable, all the rest of it. In Australia, we've got the two still running side by side. Okay, so you can't, how is open banking ever going to succeed if you've got a direct competitor running alongside it on the freeway? It's just is nonsensical. So there've been noises made about screen scraping being banned or phased out here or outlawed. Some of the banks have actually taken steps to introduce multi-factor authentication, which would stop you doing a continuous daily pull of that data, or syncing of the data. But until that happens, I genuinely don't see how you can have the two things, however open banking is ever going to take off, because there's something there that people have got built in already. They use it, it works. It's more expensive. It should be more expensive than open banking, but it's not sort of super more expensive. It's not by an order of magnitude. So I think the next step, you're talking about an accelerant. The accelerant has to be, don't give people an option to not use open banking, and that's it.
Okay, so I'm a big bank, as I talked about before. I'll just put on my big bank sympathetic hat for a second again. I've got no reason to do this, because if this increases competition, if it forces me to negotiate harder on savings, term deposit, home loans, credit cards, whatever it is, the only way is down for me. It's sort of margin compression. I don't see the opportunity for the big incumbents. Also, and we'll talk about this in a second because you're fresh from the Finnies last night, we have a vibrant, innovative fintech community in Australia that's hungry to solve consumer problems. They're far more agile, they're smaller, they don't have to look after legacy earnings, they don't have to please enormous international shareholders from, being an ASX 20 stock. So very different operating environments and very different proposition for the consumer. And I guess I'm trying to figure out how can the opportunity be shared in a way that's realistic? I can imagine the banks kicking and screaming this entire time. Obviously, they have a lot of sway when it comes to discussions and consultation papers and influence with APRA. And if this problem's been going on for a long time, I would think that's no coincidence. So you talked about the Raise example of a bunch of consumers getting together and bashing a big bank over their head to open up screen scraping, as it was back then, to enable a service that they loved. What's your advice to consumers? How can they help push this along if the government is either not equipped to or is a little bit hamstrung by some of its bigger stakeholders?
And that's tricky. I think... I guess the thing that springs to mind is the consumers don't know what they don't know.
Right.
So if they've not been presented with an option and they're not nerds in fintech like you and I, then no one's ever heard of open banking.
Okay.
You speak to anyone about open banking at a barbecue, literally their eyes glaze over and they walk away from you.
Yeah.
Left stood on your
Hopefully
own.
That's not the effect of this podcast, but carry on.
Be careful what you wish for. So I think probably the messaging, and even, as an industry, open banking's got the fintech industry focused on open banking is very prescriptive. It's the legislation's super thick, the understanding it's super thick, the compliance. It's a very non-sexy topic, at first glance anyway. So I think probably the consumer the messaging probably needs to be done, and I don't know who would run this. We've talked about the government sort of potentially investing more in making people aware of open banking.
Yeah.
There's kind of this hypothesis that you don't want people to be aware of open banking, but you want to make them aware of the benefits that it can give them, and so that's the advice for consumers.
Okay.
And I don't think the onus is necessarily on consumers to do that, because if they consent to a screen scraping flow when they're applying for a loan, they don't know that it's ineffective. No one's going to go, by the way, this is supremely risky.
Yep.
As they're filling out a form to get the loan, and the proposition's been put to them, you do go through this process, you'll get your loan in 3 hours instead of 3 weeks, because we don't need you to send in 3 months worth of manual bank statements and us to pour over them with multicolored pencils or highlighters, working out whether you can afford the loan that you're going for or not. And then the other thing I'd just go back to, you mentioned about the banks not having a huge incentive because they're sort of losing margin and losing market share. What open banking will enable them to, and what kind of screen scraping enabled them to do, was move away from that paper-based system. So they could go that their credit assessors or people in their teams could, take a 5-hour process and distill it into 30 minutes. Okay, so that's the saving there for the bank is bigger the bigger the bank is, because if they can process more loans, and they're a big bank, so they get more loan applications going through, they can process them more efficiently. So actually they get sort of a proportional benefit in something back. So I don't think it's all that the banks have sort of got everything to lose. They've got more savings to gain or efficiencies to, I guess, extract by leaning into something like that. And that's why, people did move away from a paper-based system. But there are still a number of banks out there, probably some of the smaller ones, that are still very manual in their approach to credit assessment. So, the incentive for them to adopt something like open banking is you move away from this very, very manual, transactional, paper-based system and kind of digitize and streamline your entire operation. And that makes you a more efficient business.
Okay. All right. Well, as we sort of wind up on this particular topic, I'd love to hear from you a little bit of crystal ball gazing with regard to what's coming over the hill, maybe some anecdotes from companies that you're working with that are either really operationalizing or hopefully monetizing. I think one of the other things is that, it's a very painless process to have a bank account with some little fees being taken out, not earning some interest that you would otherwise. You don't feel it. And this is, I guess, what creates the lazy tax is consumers don't feel it. They just put up with it. But the minute, let's say, Revolut wants to charge you a monthly fee for something or charge you to send out a credit card, you're sort of like, oh, hang on a second, that's not the deal. My bank gives me everything for free. And so there's this misconception that I have a big bank account that's free. They might be lending my money out and investing my money without my knowledge, but I perceive it as free. I'm curious about how consumer behavior needs to change. You talked about financial literacy and some of these apps being great for that. Acorns Raise, this sort of stuff. Consumers need to become aware of what it is, the opportunity cost of this lazy tax, in order to then say, okay, these guys have built an app. They want to charge me $19 a month or $9.95 a month for it. Do they need to do some deeper dives on how much that could potentially save them by being more proactive with this money that's subject to a lazy tax?
Potentially. I mean,
it's a behavioral thing. I see it coming out of my credit card at the end of the month. It feels like it's costing me more. I'm hoping and putting faith in consumers to do their sums and want to buy these things and want to help fund the innovation because, fintech community in Australia doesn't need less money.
No. I think you're sort of kind of right. I guess the subscription model that you're sort of talking to or alluding to there, I think, is one that's been hard for people to really succeed with or make stick, because I think you're right. I think there's the idea of paying for anything and some money going out as opposed to it being sort of slowly siphoned off, I think is a very good point. I guess my view is that maybe some of these businesses, they're very clear on the benefits that they provide to someone. They stick a subscription fee of $9 or $10 or $19 or whatever it is. They've got to be super, super sharp and laser focused on selling those benefits, because they've got to sort of say, well, Scott, it's going to cost you $20 a month. We're not just going to save you $50. We're going to save you $100 or $150. So that the 20 just seems so insignificant and inconsequential, I think. And to your point, it's the same when you're sort of selling into a business. You can sort of say, well, you're spending $500,000 at the moment. We'll give it to you for $200,000. And they'll say, but you've forgotten that it's going to cost me $700,000 to change the thing over. And that's where you're not actually saving them any money at all. So, I think your point there is very, very, very valid. And I still think I've not seen anyone, if I'm served up an app or something or my friend tells me there's this thing, I've just been through a little financial profile. I'm on my way to saving $10,000 a year in this, and this. Across 4 different financial products. Doesn't require that much effort. You just need to sync up your bank accounts. Would I do it in an instant? Yeah. No one's yet come at me with that sort of compelling message outside of having a bank account.
Yep.
Okay. So, the other fintech that we've probably not mentioned and is sort of veering into the banking category is Upbank. So they're a neobank, a digital-only bank on the app, actually owned by Adelaide and Bendigo, or mostly owned all owned by Adelaide and Bendigo Bank now. So they're fully backed by a large bank, but their user interface and the experience of dealing with them as a bank is so cool and fun, and never breaks down, never a misstep, but really sort of interesting product features. And they've probably got a bunch of stuff waiting in the wings that can really sort of change kind of the shape of financial services, particularly for millennials. I'm always a little bit surprised, although not that surprised anymore, is if you go to a pub, you're behind a younger person at the bar, they whip out this orange Upbank card. Happens all the time. So they're becoming ubiquitous. I think they've got 1 million customers now or something like that. So that's one that has a potential to really sort of change the landscape and do cool stuff.
Yeah, and I think Upbank has done well. What worries me is all the big banks have their venture businesses.
Yes.
It feels like if anyone comes up with a good idea, perhaps there's an incentive to buy it off the market before it becomes a problem for them. Upbank, great feature set. It was designed with the consumer first. Picked up by a larger bank, but then surely anything that they deliver as a product that has a sharper pricing model than their parent, then there's two sort of conflicting businesses there competing for the same dollar. I wonder how much of that is about brand and social license, versus a genuine concession to offer better priced financial services to customers than the parent. And I'm talking more broadly about, ANZ, CBA, all of their venture businesses as they pick up these fintechs. Because my concern is we're a limited population in Australia. It's we've got an outsized financial services sector, so big pots of superannuation money, a lot of house price assets, huge amounts of investment dollars sort of per capita. So we really punch above our weight in financial services, I think. Nonetheless, there's an opportunity set that doesn't always attract the biggest and the best innovators from the world to come down here and operate. And I would love to get your take on how healthy the fintech environment is in Australia at the moment, and what it needs to thrive. Because I think these innovators, they need to be able to monetize their models without thinking about being bought up by one of the venture arms of the big banks. I'd like to see a more thriving fintech community here. What does it need?
It feels like it's a bit cyclical. We're sort of in this sort of roller coaster at the moment. So it's been frothy. Then there's been a bit of a blip, and funding's dried up over the last couple of years. And it sort of feels like there's a stabilizing phase at the moment. Now, what that meant a couple of years ago was pretty much a lot of fintechs that had been funded when there was a lot of money sloshing around, but probably weren't brilliant companies, to be honest. They were probably good ideas, but just, the likelihood of them ever taking the next step to become go from a startup to a scale up, or from a scale up to a sort of medium-sized business, there were just a lot of them that were not very good. So it's almost like a resetting to the mean, I think. And I don't think that's a terrible thing. It's been quite sad sometimes. But I think it's sort of been a kind of a natural attrition that probably had to happen. I think there's a sort of a degree of soberness now, but there's also, there's some really, really good fintech businesses that are just sort of, trundling along and staying in their own lane, and they're never on LinkedIn, they're never out at awards, they're never at events, because they're being run by operators as a small business that they want to grow into a medium business, and ultimately they want to grow into a large business. So I think your point's valid about innovation. I don't really know what the answer is to that, because we do have some powerful sort of operators who have, like you say, supremely outperform and punch above their weight on a global scale. Sort of, I don't know how many of the big four in the top 10 most profitable banks in the world, but probably at least two, maybe, if not more, which is astounding if you think about it. So I don't know what the easier answer is there. I think probably some of the bank's venture funds have a better track record than others. So, if you're a fintech, make sure you get tapped on the shoulder by one of the better ones that's going to sort of support your growth rather than sort of stifle or potentially hinder it. Not deliberately, of course. But I think we're I mean, I was just in Europe at the Money 2020 conference there. It's a huge thing in Amsterdam, probably 8 to 10,000 delegates, so that's people walking around. You sort of wear out your shoes over the course of 3 days, sort of going to various different stands and talks and panels. The open banking part of the conference was pretty well attended. It's about 80% full, and consider open banking. It's not mature, but they kind of know what it is over there, and it's kind of operating across all of Europe or most of Europe. About 80% attended. Some great discussion about how to sort of move it forward. In the same arena was the Agentic AI Summit the following on the same day. So there were 2 half-day sort of mini summits within the conference. The Agentic AI thing was packed to the rafters, not a spare seat, standing room only, crowd about 7 or 8 deep, watching the talk with a guy from NVIDIA, a guy from Visa, a guy from somewhere else. And just the adoption of agentic AI in across all of financial services in Europe is not a new thing. It felt like it's not a new thing. It's almost well established. I wouldn't say mature, but there's I think there was one panel where they were talking about the adoption by some of the investment banks in Europe. UBS has 60,000 co-pilots or agents in their wealth management business. I don't know. I don't even know if that number can be right. So there's these sweeping changes, and it could be, we're in a bit of a hype cycle with that. But also, this is fundamentally going back to the point of open banking in terms of streamlining operations, making businesses more efficient. You can now take a team of 100 people and have 10 agents with 2 humans doing the same work and the same output as those 100 people. Now that's sort of, kind of mind-blowing in a way, terrifying. Yeah. But you combine that with free-flowing data and cool innovation, and you kind of get to this point where things are sort of pretty sexy. Yep. And it sort of, I came away from that. If sort of some of that, hopefully it's not all hype and it's not a bubble that's going to burst. And I don't think it is, because it's sort of moved through the hype cycle in Europe. Mm-hmm. Here, I think people are still a bit more reticent about it. They don't quite know if it's, what to do about their AI strategy or that agentic AI strategy. But I think things are going to change probably in the next 2 or 3 years pretty rapidly with regard to that.
Yeah. Exciting stuff. We're going to wind up with something a little lighter.
Sure.
So I think you pointed out that I got your handle completely wrong before, but I've remembered it. It's Superfit Dad.
Correct.
If you're on Instagram, you can find Ben at Superfit Dad. And mental health, your health and well-being. You've talked about how that sort of seamlessly fits in with some of your fintech exploits, but more broadly, I think as none of us are naive about, particularly after COVID, the importance of health and well-being in association to the quality of work you do and the way you show up to work each day. Talk me through your story a little bit.
Superfit Dad it started life as a blog that I started writing shortly after my son was born, Superfit Kid, naturally, and really I've always been pretty fit, pretty active. Prior to moving to Australia, I was sort of ran a few marathons and things like that, played football a lot, and I struggled to find time to work out or go to the gym. Felt guilty about it after Drake was born, so started blogging about my experiences and sort of doing home workouts that I then share. And it's very small readership. It was just sort of quite a cathartic experience. I've always liked writing. Build up a bit of a mailing list, and I'd send out workouts every weekend for new dads to do. And occasionally, I'd get sort of someone come back to me and say, the only only workout of the week was my workout. They'd printed it off. In the nursery, they taped it to the wall, and they'd do the workout silently while their son they were trying to get their baby to sleep and things like that. And that was sort of, I thought, well, if I get the odd email like that, then it's worth it, because I'm sort of helping myself, and I'm potentially helping a few other people as well. And I've sort of done some personal training work for fintech organizations. So I've worked with Frollo, who I used to work with, or used to work there, StockSpot. which is a robo-advice investment business, TankStream Labs, which is one of the co-working spaces. I've done some work with FinTech Australia themselves, and then more recently been doing some work with Money 2020. So took the fitness boot camps and yoga classes, which was a bit of a new one for me. So I had to sort of get familiar with that a little bit, or tweak my routine. And we delivered a fitness program that ran alongside the FinTech conference in Bangkok. So that was fantastic. That was great. Had some people come along. It was interesting. The yoga classes in the wellness area were the ones that were, would get 20, 25 people. The doing boot camp in Bangkok heat, even at 7 a.m. is about 36 degrees. That's not fun. But still a few people came along. I was the one who was sweating the most, so naturally got the shirt off. But yeah, it's just a nice way to sort of combine the two passions, the fintech and the fitness. I think it's you and I have spoken about a situation I had with the family situation a year or two ago where we lost my sister-in-law, yeah, so it's been a journey and a sort of an interesting experience since then. There's been some highs and lows for me personally in the wake of that, as you'd expect, and some very low points. And I guess the fitness and being able to do workouts through summer on the beach at Coogee and then go for a swim every morning has just been sort of, has been a game changer for me in terms of sort of keeping my head straight, Scott.
Yeah, of course. Mate, thank you very much for sharing, and thanks for being part of our inaugural podcast here. Ben Ford, thank you, mate.
Thanks for having me.